I will tell you about the role of RBI in the management of the Indian banking system. Let me give you the overview of RBI. The Reserve Bank of India, RBI, is the central bank of our country. A central bank controls all banks, financial institutions and financial firms in India. The RBI is regarded as the India's central bank and regulatory body under the jurisdiction of the Ministry of Finance. Every single task that an individual working in the RBI undertakes has an impact on the entire country. The poor as well as the rich gets affected by its policies and working. The RBI is a statutory body that performs a number of onerous functions. Now you know about the RBI. Let us know the objectives of the RBI. The objectives are controlling inflation, encouraging growth, and financial stability. I will explain you the objectives now. The first objective is controlling inflation. Central banks use inflation targeting in order to keep economic growth steady and prices stable. The Reserve Bank of India has set a target inflation band of 4% to a band of 2%. By raising interest rates or restricting the flow of money supply in the country, the RBI aims to keep the inflation in check. A lower interest rate tends to result in more inflation. When the interest rates are low, individuals and businesses tend to borrow more money from the commercial banks. This leads to a smooth flow of money in the economy. The purchasing power of people increases and thus their demand for various goods and services increases. This leads to heightened demand for goods and, in turn, causes inflation. Conversely, an increased interest rate makes people borrow less. Their purchasing power reduces, and so does the demand for commodities. This helps to keep inflation in check. The second objective is encouraging growth. One of the ways to measure economic growth is to measure GDP growth. GDP stands for Gross Domestic Product and is the total monetary value of all final goods and services produced in an economy at a given time period. A rise in GDP signifies a rise in total output. It is presumed that this output is sold in the market and exchanged for money. Hence, with a rise in total output, the corresponding income of households is likely to increase. The Reserve Bank of India aims to influence economic activity by using its monetary policy tools. It ensures the flow of credit to the most productive sectors of the economy and therefore keeping the engine well oiled. The third objective is financial stability. The objective of the RBI is also to maintain financial stability in the country. Financial stability can be defined in terms of a nation's ability to facilitate and enhance economic progress by managing risks and absorbing shocks. The financial markets and the various financial institutions are resistant to economic shocks. This stability is important because it represents a sound financial system. Stability of financial markets enables economic agents to raise and operate funds freely. Stability of financial infrastructure is used to define a condition where the financial system works to ensure that both the financial safety net and the payment and settlement system are running effectively. It is an essential condition as it ensures a healthy development of the entire economy. Now you know about the objectives of the RBI. Let us know its monetary policy. The first policy is repo rate. The interest rate at which the Reserve Bank provides liquidity under the Liquidity Adjustment Facility, LAF, to all LAF participants against the collateral of government and other approved securities. The second policy is Standing Deposit Facility, SDF, rate. The rate at which the Reserve Bank accepts uncollateralized deposits, on an overnight basis, from all LAF participants. The SDF is also a financial stability tool in addition to its role in liquidity management. The third policy is Marginal Standing Facility, MSF, rate. The penal rate at which banks can borrow, on an overnight basis, from the Reserve Bank by dipping into their statutory liquidity ratio, SLR, portfolio up to a predefined limit, 2%. This provides a safety valve against unanticipated liquidity shocks to the banking system. The fourth policy is Liquidity Adjustment Facility, LAF. The LAF refers to the Reserve Bank's operations through which it injects, absorbs liquidity into, from the banking system. It consists of overnight as well as term repo, reverse repos, fixed as well as variable rates, SDF and MSF. Apart from LAF, instruments of liquidity management include outright open market operations, OMOs, Forex swaps and market stabilization scheme, MSS. The fifth point is Elif Corridor. The Elif Corridor has the marginal standing facility, MSF, rate as its upper bound, ceiling, and the standing deposit facility, SDF, rate as the lower bound, floor, with the policy repo rate in the middle of the corridor. The sixth policy is Main Liquidity Management Tool. A 14-day term repo, reverse repo auction operation at a variable rate conducted to coincide with the cash reserve ratio, CRR, maintenance cycle is the main liquidity management tool for managing frictional liquidity requirements. The sixth policy is Finetuning Operations. The main liquidity operation is supported by fine-tuning operations, overnight and/or longer tenor, to tide over any unanticipated liquidity changes during the reserve maintenance period. In addition, the Reserve Bank conducts, if needed, longer-term variable rate repo, reverse repo auctions of more than 14 days. The seventh policy is reverse repo rate. The interest rate at which the Reserve Bank absorbs liquidity from banks against the collateral of eligible government securities under the LAF. Following the introduction of SDF, the fixed-rate reverse repo operations will be at the discretion of the RBI for purposes specified from time to time. The eighth policy is bank rate, the rate at which the Reserve Bank is ready to buy or rediscount bills of exchange or other commercial papers. The bank rate acts as the penal rate charged on banks for shortfalls in meeting their reserve requirements, cash reserve ratio and statutory liquidity ratio. The bank rate is published under Section 49 of the RBI Act, 1934. This rate has been aligned with the MSF rate and changes automatically as and when the MSF rate changes alongside policy repo rate changes. The ninth policy is Cash Reserve Ratio, CRR. The average daily balance that a bank is required to maintain with the Reserve Bank as a percent of its net demand and time liabilities, NDTL, as on the last Friday of the second preceding fortnight that the Reserve Bank may notify from time to time in the Official Gazette. The 10th policy is Statutory Liquidity Ratio, SLR. Every bank shall maintain in India assets, the value of which shall not be less than such percentage of the total of its demand and time liabilities in India as on the last Friday of the second preceding fortnight, as the Reserve Bank may, by notification in the Official Gazette, specify from time to time, and such assets shall be maintained as may be specified in such notification, typically in unencumbered government securities, cash and gold. The 11th policy is Open Market Operations, OMOs. These include outright purchase, sale of government securities by the Reserve Bank for injection, absorption of durable liquidity in the banking system. Now let us come to the important part, which is RBI's management of Indian banking system. The first point is monetary policy. The RBI formulates and implements monetary policy to maintain price stability and promote economic growth. It regulates the money supply, sets benchmark interest rates, and manages liquidity in the banking system through various tools such as open market operations, reserve requirements, and the repo rate. The second point is bank licensing and regulation. The RBI grants licenses to banks, both public and private, to operate in India. It sets eligibility criteria, evaluates applications, and ensures compliance with regulations and guidelines. The RBI also regulates and supervises banks to maintain financial stability, assess their financial health, and enforce prudential norms and risk management practices. The third point is supervision and inspection. The RBI conducts regular inspections and supervises banks to assess their performance, risk management practices, and compliance with regulatory guidelines. It examines financial statements, conducts audits, and ensures that banks maintain adequate capital, liquidity, and asset quality. The RBI also takes corrective actions when necessary to address issues and safeguard depositor interests. The fourth point is payment and settlement systems. The RBI oversees and regulates payment and settlement systems in the country. It promotes efficient and secure payment mechanisms, sets standards, and provides guidelines for electronic fund transfers, card payments, and other modes of payment. The RBI also operates various payment systems, such as real-time gross settlement, RTGS, and National Electronic Funds Transfer, NEFT. The fifth point is banking infrastructure and development. The RBI plays a role in developing the banking infrastructure in India. It promotes financial inclusion initiatives to ensure access to banking services for all segments of society. The RBI also supports the development of specialized institutions like the National Bank for Agriculture and Rural Development, NABARD, and the Small Industries Development Bank of India, SIDBI, to cater to specific sectors of the economy. The sixth and the last point is consumer protection. The RBI works to protect the interests of bank customers and ensure fair practices in the banking sector. It issues guidelines on customer service, grievance redressal, and transparency in banking operations. The RBI also establishes mechanisms for addressing consumer complaints and enforcing compliance by banks. Coming to the conclusion, I would like to tell you that in overall, the RBI acts as the guardian of the Indian banking system, with its primary objectives being maintaining price stability, promoting economic growth, ensuring financial stability, and protecting the interests of bank customers and the overall economy. Thank you for learning from options and ideas.